Well, this week, a really important week for the US markets. We have the US inflation data, of course. We also have $270 billion worth of supply of US Treasury bonds and T-bills, and the consequences for long-term interest rates from weeks like this week will be with us throughout this year as investors become more and more concerned about the booming US economy and the implications for inflation and long-term interest rates. And of course then what that does for asset prices and of course what it does for the US dollar. But we see three clear reasons why we do not expect higher long-term interest rates in the US to result in a stronger US dollar. Well, the first factor to mention is the Fed's response, and it's going to be very, very different. People look back to the Ben Bernanke infamous taper tantrum speech of 2013. But what was really important about 2013 in explaining what happened was essentially we had a marked drop in inflation expectations. Even before Bernanke's speech and certainly after his speech, we had inflation expectations drop by 70 basis points, while nominal interest rates were moving higher. So there was a huge rise in real interest rates. That's not happening in 2021. So far we've had 75 basis point rise in 10-year nominal rates, but 10-year break even has also moved higher by 40 basis points. So in other words, real interest rates in the US remain deeply negative at about minus 60 basis points. And that's a very, very big difference. And as long as the Fed communication is consistent and unified in keeping policy ultra loose, then we believe real interest rates will remain deeply negative even as nominal rates move further higher. And that's going to be a considerable drag on the ability for the US dollar to strengthen going forward. Well, the second factor, we move abroad and we focus in Europe. You know, euro dollar, as you can see here from the beginning of this year, has been trending lower. So the dollar's been strengthening, and the main reason, or certainly a significant factor there, is the very poor rollout of vaccinations in Europe, and of course evidence of a third wave of infections in key countries in Europe. But we think that the story is certainly changing. In terms of vaccinations in particular, last Friday in the 10 countries that we're tracking where there's daily data available, we had nearly 2 million vaccinations administered on Friday. So that was a record one-day total. In France, 0.5 million administered on Friday. So the rollout is definitely picking up quite notably. Also, Thierry Breton, the coordinator of vaccination rollouts in Europe, he basically stated that the production of vaccinations is ramping up. Just over 100 million vaccines were available in Q1, 360 million will be available in Q2. Also, when we look at infection rates, we're beginning to see the 7-day moving average of daily changes beginning to come down. It's tentative, but Italy in particular, France to a degree, Germany's kind of flattening, some evidence there that perhaps this third wave might be peaking out. And that, of course, would be good news as well. So that kind of negative sentiment for euro that's been very pronounced in Q1 because of COVID and the vaccinations, we see that turning. And that's going to be a big help in supporting euro dollar going forward. The third factor, remaining abroad, is what we think will be an improvement in emerging market sentiment. Now, the US dollar strength in Q1 was very US centric, and we're expecting that sentiment to broaden out as the year unfolds. In Q1, sentiment in emerging markets did deteriorate. We had net selling of emerging market portfolio securities. As you can see, just very recently, since the turn of this month, flows have returned to the emerging market space. So sentiment is beginning to improve. Now, I'm not convinced it's going to be a dramatic improvement in this quarter. Of course, COVID is still a very substantial risk in countries like India and Brazil. But as vaccinations roll out throughout this year, that should be to the benefit of emerging market countries. I think also it's worth mentioning that at the IMF meeting last week, there was progress towards an agreement to issue $650 billion worth of new SDRs. This essentially is global quantitative easing, and it is of great benefit to the smaller emerging market economies. Those countries with relatively small foreign exchange reserves will see much greater benefit from these SDR injections. In addition, some of the major developed economies have committed potentially to lending their SDRs to provide further support to the emerging market space. So this additional liquidity that will possibly come later in the summer, coupled with improvement in the COVID picture, should mean a pretty notable improvement in emerging market sentiment later this year. So I think that broadening of sentiment globally is likely to mean the US dollar comes under some renewed selling pressure later in the year.